Good afternoon, everyone. My name is Jake, and I'm joined here by my teammates, Caden, Isaiah, Corey, and Will. And we are excited to represent Team 3 from the University of Minnesota Duluth. We would like to start off by thanking the CFA Society, judges, and everyone else who helped us be here today. We are issuing a buy recommendation on Lifetime Group Holdings with a 12-month price target of $35, representing 32% upside from current price levels. We see an inflection point in the growth profile of Lifetime's business, and we believe that the market is still pricing in the old version of this business. Today, we're going to show you why that disconnect creates real investment opportunity. We see three key investment catalysts that will help lift this stock price higher. First, Lifetime's recently announced center expansion pipeline, which represents an inflection point in the growth profile of Lifetime's business, driven by larger next-generation formats. Second, a higher yield membership mix, which supports higher average revenue per membership, driving meaningful margin expansion. Our third and final catalyst is a wellness trend across the affluent consumer base, providing durable demand for Lifetime services. I'll now pass it to Caden to go over business overview.
Thanks, Jake. Lifetime Group Holdings was founded in 1990, opening its first club in Brooklyn Park, Minnesota. From the beginning, Lifetime found its edge by introducing an athletic country club model, combining premium fitness facilities with lifestyle and social amenities all under one roof. Fast forward to today, Lifetime now operates more than 180 clubs across the United States and Canada. Each club is specifically designed to be the comprehensive wellness destination in its market. This model supports higher member engagement, reducing membership churn, and ultimately promoting a stronger membership mix. But the real question isn't just how the model works, it's how efficiently it can be scaled. Historically, Lifetime owned its real estate, requiring heavy capital investment to open new clubs. Following the company being taken private in 2015, they pivoted to an asset-light strategy, executing sale-leaseback transactions to sell owned properties to real estate investors and then lease them back. This allows Lifetime to quickly convert long-term fixed assets into cash that can be reinvested into growth. The impact is straightforward. Lower capital per club and higher operating output drive EBITDA growth, driven by margin expansion and larger format clubs with higher target utilization rates. With lease cap rates sitting somewhere in between 6 and 7%, very similar to Lifetime's long-term debt, we view financing expansion through sale-leasebacks to be an attractive avenue of growth, enabling Lifetime to redeploy capital into higher return opportunities. This strategy shows through in Lifetime's expansion plan, as we are seeing an inflection in new club growth from 2025 onwards, supported by cash generated through sale-leasebacks. Management has guided 12 to 14 new club openings from 2026 onwards, and also guided that new clubs are expected to be larger on average than previous generation formats. Larger format clubs improve returns by one, having higher optimal utilization rates, which leads to lower fixed cost per member, and two, more space to add opt-in amenities that drive in-center revenue growth and promote a stronger membership mix, such as life spa, childcare amenities, and pickleball. When looking at a breakdown of revenue, more than half of all growth can be attributed to new and ramping centers, making continued club expansion a cornerstone in our investment thesis. Now pass it to Isaiah to go over industry overview.
Thank you, Caden. Lifetime operates in the health and fitness industry, a moderately cyclical segment of the consumer discretionary services that benefits from rising disposable income, strong labor market conditions, and long-term demographic shifts. The industry has seen a strong growth in recent years as a result of the millennial and Gen Z generations, with data showing these generations are allocating a larger share of their discretionary spending towards activities that support their long-term wellness and physical health. Lifetime is well positioned to take advantage of this shift as its clubs feature premium fitness facilities paired with other social and lifestyle amenities. Looking at the competitive landscape, we have identified three major tiers within the fitness operators segment of the health and fitness industry. First, we have low price. These gyms operate in the broader market via their price point alone, with memberships often starting as low as $10 per month. These gyms appeal to the lower income consumers, but will also feature less amenities than their higher tier competitors. Second, we have the mid-tier gyms. These operators charge more for their services, often $40 to $75 per month, but also provide a stronger amenity base than other gyms. Finally, we have premium athletic clubs. These operators charge a premium for access to their facilities, but will also provide a wider breadth of amenities, from lifestyle cafes to indoor-outdoor pools and childcare facilities. We view Lifetime as the leader in this segment, supported by its nationwide presence and superior amenity offerings. Now Jake will go over our amenity analysis.
Thank you, Isaiah. To assess competitive positioning, we analyzed 20 clubs across 5 overlapping markets and scored across 10 amenity categories, which included recovery services, racket sports, aquatics, and programming depth. Lifetime clearly ranked highest, standing out as the only club offering a full suite of aquatics, racket sports, and recovery services all under one roof. Lifetime also showed the most consistency across each of its locations. We viewed Equinox as the closest comparable given its brand positioning and brand pricing. While both offering those core fitness experiences, Lifetime Equinox lacks that country club style ecosystem that really differentiates Lifetime from its competitors. I'll now pass it to Corey to go over ESG.
Thank you, Jake. We constructed an ESG scorecard for Lifetime, arriving at a total score of 74 out of 100, which we view as an average grade, with environmental, social, and governance scored at 75, 80, and 68 respectively. Starting off with environmental, Lifetime has improved emissions and water efficiency, which are materially relevant for a large and energy-intensive club model. This operational efficiency helps reduce input volatility and protect long-duration real estate assets. Next, on to social, which we view as the strongest pillar. Employee engagement and workforce diversity strengthen brand consistency and premium positioning. In Lifetime's experience-driven business model, these metrics directly support retention and demand durability. And lastly, on to governance. Lifetime's performance-based compensation and broad board oversight align directly with shareholder interest and mitigate execution risk as club expansion accelerates. And now I will pass it to Will to go over financial analysis.
Thank you, Corey. Starting with margin expansion. Margin expansion is driven by scale, not price pressure. As new clubs mature, fixed costs like staffing, rent, and utilities are spread across a larger, more stable membership base, creating a natural operating leverage. Asset efficiency improves as utilization increases. Higher visit frequency, household memberships, and premium offerings allow each club to generate more revenue per square foot without meaningful cost increases. Now on to material deleveraging. Lifetime is actively de-risking the balance sheet through deleveraging. Strong, reoccurring cash flows from maturing clubs allow the company to reduce reliance on debt while maintaining growth investments. A stronger capital structure supports sustainable equity returns. As leverage declines, earnings growth increasingly translates into shareholder value rather than servicing its debt, reinforcing ROE expansion driven by operations and not financial engineering. Finally, onto ROIC analysis. ROIC expands as clubs move from build-out to harvest mode. Once stabilized, new locations generate materially higher returns as fixed costs flatten, margins expand, and incremental revenue requires minimal additional capital. Improving asset productivity amplifies returns on invested capital. Higher revenue per club and standardized designs increase output per dollar of invested real estate, lifting ROIC through stronger asset turnover alongside margin gains. Now I'll pass it off to Jake to go over valuation.
Thank you, Will. Our valuation was primarily based on a DCF analysis supported by relative EV to EBITDA framework. We use an 8% WACC reflecting Lifetime's improving balance sheet, stronger cash flow, and its deleveraging, while still accounting for industry cyclicality and its capital-intensive model. For our terminal assumptions, we used a long-term growth rate of 2.5%, consistent with mature operator growing in line with population and real income trends. As a cross-check, we applied a 10 times EV to EBITDA multiple to 2029 EBITDA, supported by margin expansion from 24% to 28% and meaningful deleveraging over our forecasting period. I'll now pass it to Isaiah to go over investment risk.
Thank you, Jake. We have highlighted three main risks that pose a significant threat to our thesis if they were to materialize. First, any slowdown in the guide and expansion plan for club openings could have a material impact on the top line and long-term margins for Lifetime. We feel this risk is sufficiently mitigated through the overall cash flow generation and sale leaseback strategy, as well as maintaining a thorough pipeline of potential sites and scouting MSAs years before committing to the project. Our second risk is memberships growth softening, either through membership mix. We view that membership mix, Lifetime mitigates this risk by staying in tune to fitness trends and optimizing programming and continue to add amenities that boost membership engagement and reduce churn. Finally, a slowdown in affluent consumer spending could cause the higher income consumers to shift their discretionary spending away from Lifetime's premium services. However, we feel that this risk is mitigated through the overall resilience of Lifetime's consumer base. We would like to reiterate our buy recommendation on Lifetime with a $35 price target, supported by our three investment catalysts of the accelerating center expansion pipeline, improving membership mix driving meaningful margin expansion, and the wellness trend among the affluent consumers. We would love to open the floor for questions.
So I can start with by all the rent. So how did you capitalize the rent and deal with that in the valuation? Because part of the evaluation is using EBIT to EBITDA, or EV to EBITDA.
We'll get him on that. Yeah, so the reason for the EV to EBITDA was because of Lifetime's higher leverage due to that rent and buying out those real estate. So that was kind of the reasoning for the EV to EBITDA, just because if we use like a price to earnings, it might get diluted by the net income from accounting differences and those one-time expenses and those operating expenses.
But when you did EV, did you capitalize rents to come up with an adjusted debt?
Yeah. Hi, I'm Caden. I can touch on that. So yeah, when we calculated our net debt, we did treat operating lease liabilities as a form of debt for the company because they're essentially financing their expansion through sale leasebacks rather than issuing notes, essentially.
You've got EBITDA margins growing steadily in your slide. You break that apart and tell me how much of that is actual operating income growth and how actual operating margin growth versus D&A.
Could you repeat the question, please?
You have steadily growing EBITDA margins showing in that graph. If you decompose that into actual operating margin plus D&A, how much is the D&A component driving that operating margin expansion or that total EBITDA margin expansion? How much is EBIT?
How much is needed?
How much is it needed? Is there EBIT expansion or is it all D&A?
From how we've broke down our evaluation, we look from the standpoint, again, with the sale leaseback transactions, we see when the company is leasing out those buildings, taking away the building accumulated depreciation. We took it mainly from a business standpoint.
In one of your other sites, you used adjusted EBITDA. What are the adjustments that you are making? Are you making those adjustments, or is that what management is telling you to do in their version of it?
So our adjustments came from adding back executive compensation, and we treated that sort of in line with management guidance for the most part.
Say that again. You're adding back management compensation?
Yeah, we just added back. So our adjusted EBITDA was EBITDA adding back executive compensation.
Why would you do that? It's real money.
I guess I don't have a great answer for that. I'm sorry.
Okay.
I have a related question. I think it's interesting to hear about how you think about the forecast for the rates environment going forward and how that affects the choice to sell or reduce back rather than continue to own the place.
So are you asking for our, like how we're forecasting interest rates going forward?
Yep, so if rates continue to go down, if rates go up, how does that affect that decision making? What is the forecast need to be for your model to make sense?
Yeah, so what we looked at using what Lifetime has issued, they have partnerships with Morgan Stanley and JP Morgan that issue a $999. Let me retract that a little bit. They're using a floating rate across this time to help keep these fixed rates and not, so they are not so much relying on what the interest rates do over time. They have this fixed rate that they are in contract with.
So that means you from fixed to floating.
Yes.
Okay, and so which direction do interest rates need to move in that for this to be a good choice?
If it's to be a good choice, if interest rates are raised, you can see that's a positive outcome for them.
Maybe one other one related to that. Did you try to evaluate health facilities like this tend to need a lot of care and feeding. Right? Things wear out very quickly, so CapEx can be fairly substantial. Did you think about that in the context of having an owned versus a leased facility, and ultimately if that really drives a lot of value?
Yeah, so when we calculated net cash flows from investing activities, we forecasted pretty significant CapEx because, as you said, just the model just generally generates a lot of CapEx. And with this expansion plan, before they can actually go through sale leaseback transactions, they do need to put up a decent amount of capital up front to essentially build the center and ramp it. So I would say relative to CapEx, we did have pretty significant CapEx growth, and then some of that just being offset to some extent by proceeds from sale leaseback transactions.
Speaking of expansions, how do you guys project from load out to stabilizing? You know, obviously you have the terminal value growth rate of 2.5%, but in between, how do you model that in terms of the build out to stabilizing their revenue?
So through, in terms of how we modeled it, from 2026 through 2029 in our forecast years, we just chose to use the middle point of their guidance, which is 13 new clubs, and the average square footage of 95,000 square feet, which we tied to our revenue number. And then after that, we didn't go through actually forecasting how that will start to plateau in terms of new club growth, but we're kind of expecting that to some extent growth could moderate a little bit, but in the next few years, they have quite a ramp in terms of what they can do in growing their business.
Okay, thanks. Did you see some of the historical bankruptcy or those kind of issues?
Sorry.
Or did you look at some of their historical execution, their track record, when you look at their expansion model?
Is that the management execution on?
Judges, can you just use the microphone when you speak into it?
Oh, okay. Sorry, I thought I had a loud voice.
I think they're pulling something up for years.
I thought I could hear myself pretty loud.
Hopefully he'll pull it up, but yeah, we did look at what management has guided versus what they've managed to execute, and looking for the most part, they've been right in line with a couple misses and a couple beats, but relatively very close to what they've guided in the last few years since they re-IPO'd.
Okay, thanks.
I noticed on some of the valuation variables. I noticed on some of the valuation variables, especially the margin growth and the return on invested capital growth, seemed a little bit almost rosy. What happens if, and did you model out, what if those expectations maybe level out closer to current rates, and how did that impact your valuation target and your buy, hold, sell recommendation?
So, I can touch on that, kind of more of the bear case, kind of looking at the bears' downside risk, downside catalyst, looking at macro sensitivity and discretion risk. So they're looking at memberships as non-essential. Our argument to that is that they are targeting affluent consumers, where a moderate recession isn't going to target them or affect them as much as the low to middle income earners. As well as new club expansion, and it kind of ties into valuation factors, is the new club expansion and the valuation are kind of tied to where there's not much room for a lack of execution on the new club expansion, and that's where the valuation, and when we're grading our valuation, if we don't hit on these expansion, we don't hit these revenue numbers, and so that's kind of how we're looking at it from our downside bear case.
Maybe talk a little bit more about your assumption on weighted average cost of capital, and what, if you were investing your own money, is a 8 to 9% return on capital on this business adequate compensation for the risks?
1 minute, guys.
Yeah, so looking at our WAC build out, we used a 6.5% pre-cost of debt coming from yield to maturity. We had a tax rate of 25. After tax cost of debt came out to 4.84%. We used a risk-free rate of 4.1, market risk premium of 4.5, and a beta of 1.2, which is our 3-year adjusted monthly, bring out to our cost of equity of 9.68, which brought us to our WAC. And coming with that WAC, we are in line with the consumer leisure industry itself. They're about a 7.9% to an 8.9%, and we felt pretty comfortable with the WAC of 8%. And we feel that the 8% looks at the consumer industry leisure cyclicality compared to the market, and we believe the 8% is justifiable.